give you the markets update now. The JSE looking set to contend with mixed global sentiment, with investors still jittery as inflation and a weakened global economic outlook persists. The local bourse may also benefit from an announcement late on Friday that ratings agency S&P Global Ratings has bumped up the outlook on South Africa's sovereign debt to positive, but it remains in junk status. To speak to us now about the latest market moves is Rella Suskin. She is head of research at Benguela Global Fund Managers. Rella, good morning to you and a warm welcome on this Monday, very cold Monday. Give us a sense of how the markets have opened in early trade after the mixed sessions last week.
Yeah, good morning. I think this week is probably going to be a very similar reflection of last week and a lot of mixed trading. I mean, this morning the market opened up quite positively, particularly our SA markets up about 1.3, 1.4% at the moment. But the drivers behind it is largely the gold sector. So our gold stocks are higher. The gold price is up close to 1% this morning. A couple of factors impacting that. We're seeing rising COVID cases in Beijing, and so residents are being told to stay at home again. Also, Biden was speaking this morning saying that he would defend Taiwan if China were to attack it. So again, geopolitical issues coming up driving the gold price higher. But really across global markets, U.S. futures positive. A big driver there again, Biden saying that he might look to remove tariffs put on by Trump's administration, import tariffs, to try and combat the high inflation.
Let's talk about that move from S&P Global Ratings agency, joining Moody's Investor Services in raising the outlook on South Africa's rating, but some analysts a bit skeptical, warning that there is no guarantee of upgrades, that the country will remain basically in junk status as far as our sovereign debt is concerned. This is over the next 2 years. Your thoughts?
Yeah, I probably agree with most of those analysts as well. I mean, I think the outlook is positive. But I think coming out of junk status, the government's going to have to put in a lot more structural reforms. Some of the key points that led to the improvement in the outlook is what I think are quite temporary. It's largely the higher commodity prices. We're seeing higher coal, iron ore prices as a result of the China-Ukraine war. That's definitely helped the fiscal position, but whether that can continue over the longer term is uncertain. We've also seen quite a boost in consumer spending over the short term. But again, it's more of a recovery from, being stuck in COVID conditions.
Yeah.
Again, the sustainability of that is uncertain.
Let's talk company news for a bit. Dis-Chem Pharmacies publishing their results for the 12 months, which ended on the 28th of February 2022. How are their numbers looking?
Yeah, so it was a good result from Dis-Chem. Group revenue up 16%. Their headline earnings per share up 27.6% to 99 cents per share, which is slightly ahead of what the market was expecting. So, as we have seen, the share price has reacted positively to that. I think just to note, in the 16% revenue growth, 6%, I suppose the comparable growth from comparable sources only up 6%. We must remember that they've been very busy acquiring quite a few acquisitions, and that's definitely boosted their top line growth. We are seeing a favorable mix to pre-COVID conditions where there's a higher mix of beauty products in their sales, and so that's also assisted their margin improving.
Yeah, let's conclude the conversation with Netcare also posting their interim results. Talk us through their numbers.
Yeah, it was also a good result from Netcare. I mean, it was well guided. They came out with a trading statement a couple of weeks ago. We're seeing 2.3% growth in revenue, but an improving bottom line growth, so 29% growth in earnings per share. The main reason for that improvement in earnings per share, well, there's two really. they've been they've been trying to increase the digitization in the business, which is helping costs. But the main one is the improvement in occupancy rates from sort of, during the peak of COVID levels. We saw December and January was still heavily impacted by COVID as we went through the fourth wave. But as we see the February and March results come out, those occupancy levels sort of really improving to close to pre-COVID levels.
Yeah. Rella Suskin, let me thank you very much for that markets update. She is the head of research at Benguela Global Fund Managers.